Welcome, fellow traders, to an exciting new video. Today, I'm thrilled to reveal one of the most powerful scalping trading strategies you can implement right away. The best part? You won't even need to rely on higher time frames for your analyses. This comprehensive strategy covers every crucial aspect, from setting up the perfect stop-loss and take-profit levels to mastering the art of entry models and much more. If you're eager to boost your trading game and seize lucrative opportunities in the markets, you've come to the right place. I'll walk you through step by step, ensuring you grasp every essential detail with ease. But before we dive into the strategy, be sure to hit that subscribe button and ring the notification bell. That way, you won't miss any of our future trading tips and exclusive content. So, grab your favorite trading notepad, fasten your seatbelt, and let's embark on this exhilarating trading journey together. Get ready to take your trading skills to a whole new level with this game-changing scalping strategy. Let's dive in. In this highly anticipated video, get ready to discover the art of executing sniper entries with an incredibly tight stop-loss. I'll guide you through the precise techniques that will allow you to enter the market with laser-like accuracy, minimizing risks and maximizing your potential gains. Say goodbye to uncertainty as you master the art of pinpoint entries that could change the way you trade forever. But that's not all. We're taking it a step further. Learn the invaluable skill of crafting exit strategies that will help you profit from the market with confidence. Understanding when and how to make your exit is just as crucial as finding the perfect entry point, and I'm here to ensure you have all the knowledge you need to succeed. Accurate entries are one thing, but making insane profits is a whole new level of trading mastery. In this video, you'll not only learn how to enter the market with precision, but also how to capitalize on those entries to generate substantial returns. It's time to take your trading to a whole new level and embrace the potential that lies within these powerful strategies. And that's not all. I'll also reveal some of the best-kept secrets to holding your trades longer and adding more positions to maximize your profits. By the end of this video, you'll have a comprehensive toolkit to enhance your trading skills and gain a competitive edge in the market. Before we get started, make sure to check the video description for timestamps of each topic we'll be covering today. Even if you are a beginner, this video will be covering everything to put you on the right edge. In our first topic, we'll delve into the fascinating world of drawing supply and demand zones. Now, let's focus on supply zones. When we encounter a supply zone, our strategy will revolve around taking a sell position. On the flip side, when we approach a demand zone, our approach shifts to seeking buy setups. Here, I'll teach you the essential factors to consider when looking for potential buy entries. Traders, on this step-by-step tutorial, we'll go deep into the demand zones and their drawing techniques. A demand zone, as shown on this first one, is a candlestick pattern that we draw from the previous candle's open to the low of either the bullish or a bearish candle. At the second mark, notice how the bullish candle doesn't engulf the previous one. This pattern often appears at the start of a bullish trend, giving us a strategic advantage for future trades. But that's not all. Stay tuned for even more candlestick patterns that can further enhance your trading skills. Supply zones are simply the opposite of demand zones. As shown by the first candlestick pattern, a supply zone is formed using a bearish engulfing candle. This candlestick patterns, you are most likely to see them on the lower high or at the beginning of bearish trend. To draw a supply zone, we start from the previous bullish candle's open and extend it to the high of either a bullish or bearish candle. Drawing supply and demand zones perfectly as a beginner can be quite challenging at first. To understand them easily, first you have to understand how bullish and a bearish candlesticks are formed, like where they open and close and their highs and lows. This knowledge will help you react faster in the market, because if you are slow, you can easily miss a lot of profitable trading opportunities. On to the last supply zone. It might be a bit challenging for beginners, but don't worry. I encourage you to backtest it on the market to get the hang of it. This version is called the non-engulfed version, and sometimes it's formed by a doji candlestick. Remember, draw the supply zone from the previous bullish candle's open to the higher high of either a bullish or bearish candlestick. Choose the one with the higher high. In this section of the video, I'll reveal two essential methods for drawing supply and demand zones to keep you prepared when price reverses near these zones. First up, the demand zone. Take a look at the example where we draw the zone from the previous candle's high to the low of either a bullish or bearish candle. Remember, the choice depends on the market conditions. In this case, the bearish candle has the lower low, so that's the one we use. We can give it a name and call it wick to wick of a demand zone. Continuing our exploration of supply and demand zones, the same principles apply to supply zones. Pay close attention to the wick to wick movement in this example. We draw the supply zone from the previous bullish candle's low and extend it to the high of either a bullish or bearish candlestick. In this case, the bearish candle has the higher high, so that's what we use. This powerful pattern can serve as a sniper model for your trades, offering precise entry in the market. If you want a dedicated video where I demonstrate this pattern in detail, simply comment below to request it. Let's revisit an important concept I like to call open to wick. I find it crucial to reiterate for a deeper understanding. Open to wick refers to drawing our zones from the previous candle's open. As you can see clearly from both examples, we start by marking the zones from the open of the previous candlesticks. For the demand zone, the low remains the same as this, is where we'll place our stop loss. We'll explore this further in the next section. Now when it comes to the supply zone, the process remains unchanged. We still choose the high of either a bearish or bullish candle to complete our zone. Let's move forward to demonstrate other patterns so that you can even understand better on how to draw supply and demand zone. In this section, we're focusing on the first demand zone pattern, known as open to wick. Pay close attention as I explain this. As you can see, we draw the demand zone from the previous candle's open. However, what sets this pattern apart is that the bearish candlestick has a lower low. Let's explore the second demand zone, which presents an engulfed version. Although the pattern looks different, the concept remains the same. As before, we draw the zone from the open of the previous bearish candle, extending it to the low. However, in this case, we notice a bullish candlestick with a lower low. In such scenarios, we approach the candlestick with the lower low to define the demand zone. Let's shift our focus to the supply zone, which presents an engulfed version. This first pattern is essentially the flipped version of the demand zone we discussed previously. As we take a closer look at how this supply zone was drawn, you'll notice that we begin from the open of the previous candlestick's open. Then, we extend the zone to the higher high of either the bullish candlestick or the bearish candle. In this case, the bearish candle has a higher high. Therefore, we use this candle to draw the entire supply zone accurately. In this final supply zone example, things may seem different, but fear not, the concept remains the same. Just as before, we'll begin drawing the supply zone from the open of the previous candle. Then, we move to the higher high of either the bullish or bearish candlestick. Here, we notice that the bullish candlestick has the higher high. Therefore, we'll use this specific candle to complete the supply zone with precision. By now, I hope you have a solid knowledge of drawing supply and demand zones. In this section, I'll introduce you to the only trading pattern you need to focus on in the market to make your entries. As you know from now on that every trading strategy that we share, we will always share it with a full detailed rules. So on this section of the video, I will explain the 4 rules that we need to focus on before taking any entries. Pay close attention as we dive into the details, as things might get a bit challenging. But rest assured, I'll do my best to explain everything in the simplest way possible. We will start by doing a bullish structure pattern before we can do a bearish setup. Step 1 is all about identifying the area of the demand zone. This step allows us to pinpoint potential reversal points in the market. And remember, in the demand zones is where we are expecting possible bullish trade setups. Also, don't forget to draw your demand zone on the chart, because this will help you to structure your analyses better. Step 2. I have noticed in some of our videos that most people find it hard to find the low where the market needs to break the structure before moving higher. But then, I have discovered the simplest way possible to teach you guys. Above our demand zone, we have to also find a bearish candlestick where we need or expect price action to trade below it. And a close look of this bearish candlestick in the lower time frame will look similar to this illustration. Then we will be looking for the market to trade below this low before we can see another bullish trend. Step 3, where you will learn how to make entries in the market with precision. To enter the market, we rely on a candlestick close, which we call a confirmation candle. A confirmation candle confirms our entry, but we must wait for steps 1 and 2 to be in place before anticipating the confirmation candle on the zone. In the case of a demand zone, a bullish candlestick close serves as the confirmation. Before the market presents a confirmation candle, we need to witness price action touching the zone first. Now you may wonder how to distinguish a true confirmation candle from an incorrect one. Let's understand which one to choose, and which one to avoid when the market presents that kind of candlestick. In the first example, price touches the zone and closes with a bullish candlestick. This is the correct confirmation candle, and we can also see that price is still trading in the range of the demand zone. However, in the second example, price touches the zone, but there's a wick below the demand zone. In such cases, the market has invalidated the zone, and this pattern should be avoided. Now that we've covered all the steps, now moving on to the final step, step 4. Here, we'll focus on making our entry and placing our stop loss. Every successful trading strategy should have a solid stop loss, entry, and exit model. After price confirms our entry with the bullish candle close, we'll enter the trade. To protect our capital, we'll place the stop loss below the demand zone. As for the take profit target, we'll aim for the previous swing high to maximize our potential gains. One very important step before entering the trade is to add the spread size below the demand zone. This will help us avoid unnecessary stop-outs and to ensure less risky trades. Because some brokers, when it's time to shift to another trend, some brokers are likely to open their spreads. Now that we fully understand the bullish structure setup, we'll explore real-life examples. But before that, let's take a closer look at the bearish setup. If you've reached this part of the video, I have a bonus for you. You'll receive a free PDF file containing all the materials used in this video. To access it, simply find the link in the description below. Additionally, don't miss the chance to join our free Discord server, where you'll receive free weekly signals. The link to the server is also provided in the description. Now let's go deep into the bearish setup. Just like the bullish setup, this one is flipped, but the rules remain the same. Step 1. We'll identify the area where we'll draw our supply zone. On the supply zone, we'll be looking to make sell positions. Step 2. We need to identify the bullish candlestick that we want price action to trade above, when price is trying to move higher to the supply zone. Step 3. Once price action moves higher to reach the supply zone, we'll start looking for sell setups, while also observing for the confirmation candle. In this case, the confirmation candle will be a bearish candlestick close. Step 4. Finally, at this step, we'll enter the market with calculated risk and place our stop loss above the supply zone to protect our capital. Let's put our newly acquired knowledge into practice with real market examples. This scalping trading strategy is versatile and applicable across various time frames, including 1-minute, 5-minute, and 15-minute charts. As for the question of which pairs to trade, let me assure you, it works across multiple markets such as Forex, cryptocurrency, indices, stocks, and beyond. Now let's start with example 1 and apply the rules we've learned. Through these practical demonstrations, you'll gain a deeper understanding of how to navigate the markets with precision and confidence. To simplify our approach, we'll plot the rules on the chart and use them as guidelines to aid us in making better decisions. Now that we have the rules plotted on the chart, let's analyze the current market situation. Observing the chart, it appears that we are currently in a bullish trend. Our goal is to try and catch the next bullish wave. To begin, we'll first identify the demand zone from where the previous bullish trend originated. Now that we've successfully drawn the demand zone on the chart, our next task is to identify the precise location where we want to see the bearish candlestick above the demand zone. As we discussed earlier in the beginning of the video, this bearish candlestick serves as a valuable tool to spot the low that needs to be taken out. I have noticed that it can be challenging for some traders to identify this low. But with the help of the bearish candlestick, we can identify that low very easily now. Let's focus on finding that bearish candlestick positioned above the demand zone. Observe that the bearish candlestick is currently positioned above the demand zone and aligns perfectly with the low point. Before advancing to step 3, which involves identifying the confirmation candle, we need to conduct a thorough market analysis. This will also help out if you're trying to make a signal for yourself or your fellow traders. Your analysis might lead you to anticipate that price will come to the demand zone and form a confirmation candle without breaking below it. Now, exercise patience and let the market play out, and wait for price action to touch the zone and wait for a bullish candlestick close before entering the bullish trade setup. This bullish candle will be our confirmation candle. Let's observe how the market unfolds after it has traded below the previous bearish candlestick or the manipulated low. In step 3, we observe that price has touched the demand zone and formed a wick, followed by a bullish candlestick close. This bullish candlestick signifies a bullish presence in the market, presenting us with an opportunity to join the trend with a limited risk. Now let's leverage this bullish momentum to our advantage and enter the trade strategically. I'll guide you on how to execute the entry and effectively place your stop loss to safeguard our capital in case the market goes against our analysis. To enter the trade, suppose you're analyzing the 5-minute time frame, which is an active period in the market. As you closely observe the price action and candle close, once it touches the demand zone and closes with a bullish candle, you can enter the trade right when the confirmation candle closes. To protect your capital, set the stop loss just below the demand zone, considering the added spread to avoid unnecessary stop-outs. Additionally, I have an extra trick to catch the wicks of the next few candlesticks before the market moves higher. If you're interested in learning this advanced technique to further enhance this strategy, make sure you are subscribed to our channel, Easy Forex Strategy, and hit the notification bell. This way, you'll be notified whenever we upload new content and trading tips. Now, as you observe price action, you can see that it has surged higher, surpassing the previous high. At this point, a good strategy would be to close some of your trades, securing profits while allowing the remaining positions to continue for further gains. By taking profit at the previous high, you safeguard your trade, and it's wise to adjust your stop loss of the running trades above your entry price, ensuring that you're at a break-even point. Essentially, you've created a risk-free situation where you can enjoy the benefits of free money. This technique of securing profits while leaving room for potential gains is known as locking in profits. It's a smart move to protect your capital while maximizing your trading potential. In this next example, pay close attention, as you'll witness the true power of this scalping trading strategy. By using the 4 essential rules, you'll discover how this approach enables you to enter more trades in the market. As you can see, the market experienced a significant aggressive drop. However, don't be disheartened, as this doesn't imply that we can't find potential buy setups. To proceed systematically, let's plot all 4 essential rules and meticulously analyze if the current market condition align with our trading strategy. Here's a valuable piece of advice for every trader. Remember that every uptrend will eventually experience a retracement. In this particular scenario, the market has dropped, leading us to transition into a consolidation phase. This is where we'll apply our scalping strategy and try to catch some bullish moves. Let's see how many trade setups we can find. Now that we have all 4 important rules plotted on the chart, let's follow each one, and we begin with the first rule, which is to draw or identify the demand zone. And traders, don't forget that we draw the zone from the previous bearish candle open and going to the low. Now that we have identified and drawn the demand zone on the chart, let's add another valuable concept to enhance our trading strategy. Now we will add what we call a fair value gap, or an imbalance. An imbalance is very easy to understand. Imagine it as a space between the wicks of 2 candlesticks. On the other hand, an imbalance occurs when price moves aggressively within a short period of time, leading to gaps in the market. The market tends to reverse back and close these gaps. In this case, we will use the imbalance to help us to spot trading opportunity that are highly profitable in the long run. Moving on to step 2, we'll focus on finding the bearish candlestick that we need price to trade below it before price can reach our demand zone. Here's the bearish candlestick that we need price action to come and trade below it. And remember, traders, that this candlestick will serve as a low that we want price to manipulate. In this way, this will give us an edge over other traders. But before we move on, let me show you how our analyses will look like. This is how our analyses will look like in this 5 minutes time frame. And to make sure that we make profit, we will make our take profit at the previous swing high. So now what's left for us is to wait for the market to come to the zone and close with a bullish candlestick. So let's see how the market unfolded. As we observe the price action, we can confirm that it has traded below the previous low, marking the fulfillment of step 2 in our trading strategy. Price has touched the demand zone and closed with a bullish candlestick. This bullish candlestick acts as confirmation candle, providing us with the green light to enter the market with confidence. We will execute the trade without fear, positioning ourselves strategically in the market. We'll set our stop loss just below the demand zone with added spread different, ensuring that our capital is well protected. It's time to let the market do its job, as we wait patiently. Now, if you're considering to add more positions to further capitalize on the market's potential, let's proceed with caution, aiming to target the previous swing high as our take-profit level. In this area, we'll swiftly revisit all the essential steps of our trading strategy to try to find more trading opportunities. As you can see by doing the same analyses, we have spotted a demand zone, a bearish candle that we want to see price trading below it. And now at the current market price, we can see that price has touched the demand zone. So now what we have to do is to wait for the market to close with a bullish candlestick to confirm our entry. And last but not least, we will place our stop loss below the current demand zone. Okay, here, we will enter the same way as the previous trade setup. At the current market price, we can see that we have spotted a confirmation candle, which is represented by a bullish candlestick. We will enter the market now and wait to see if price will hit our take-profit level or not. As of now, we've successfully executed 2 profitable trades within the same trend. Now, the question arises, should we consider trying for another trade? The market operates on the principle that price is never permanently high or low. Hence, we can explore the possibility of initiating another trade at this higher level by using the same proven rules for this trading strategy. Backtesting extensively leads to a clear understanding of the strategy, resulting in cleaner charts. It's a task I encourage you all to undertake and share your experiences below to benefit other traders. With this analysis completed, our next step is to patiently wait for the market to present a confirmation candle. With a bullish candlestick now on the zone, we will apply the same model to enter the market. Our take-profit level remains unchanged, targeting the previous swing high. Boom! With 3 successful trades resulting in profits, now we can see the power of this strategy is evident. Now, here's one piece of advice after watching this video. Please do take some time to backtest this trading strategy for at least a month or more. Always use a proper stop loss and calculate your risk when entering trades. Without these principles, this trading strategy won't yield the desired results. Remember, trading involves both winning and losing trades. If you experience a challenging week, consider taking a few days off to regain focus. Stay productive by backtesting and maintaining the right mindset. Now that we've covered bullish examples on a real market chart, it's time we explore bearish setups. By doing both bullish and bearish signals, you'll be able to trade from both perspectives. And before we begin, please show your support by liking the video and also comment with your country name and flag to meet other traders from all over the world. So now we will do our sell setup at this current market chart. As always, we begin by jotting down our 4 essential rules to ensure we never lose sight of our objectives. On the first step, we start by identifying the supply zone. This step sets the foundation for our bearish trading setup, enabling us to pinpoint potential reversal area. After we have identified our supply zone, we can add another step by marking the previous highs and lows. This additional analysis allows us to gauge whether the market has manipulated either of these previous swings. We can notice here that price has gone above the previous high or spiked above, indicating that some traders may still be holding on to long positions, potentially being trapped. Then price traded below this previous low, suggesting a potential shift towards a new bearish trend. Moving on to step 2, we'll mark up a bullish candlestick that we need for price to trade above it before it reaches the supply zone. As we proceed, it's worth mentioning that our analyses will appear simple and uncluttered, just like this one. We predict that the market might experience a downward push after touching the supply zone. But we also need to see a confirmation candle. Here we can see that price traded above this bullish candlestick below the zone, And now price also reached the supply zone and closed with a bearish candlestick. So when you see something like this, just know it's time to calculate the risk and enter the market with proper risk management. Now that we have our confirmation candle, we have to set and forget or manage the trade properly. And remember, our stop loss is always above the current supply zone, with added spread size. Traders, it seems we've reached the end of our video. I sincerely hope you've enjoyed the content and found it valuable. Before we part ways, I have a delightful surprise for you. If you want the best backtesting software in the market right now, please be sure to check out in the video description below. Additionally, I've included more examples at the end of this video for you to explore and learn from. So, sit back, relax, and enjoy the additional content with some soothing lo-fi music playing in the background.